Yeah, I'm looking forward to that solo 401k portion of things. That's going to fit in nicely with this. Um, so, hey everyone, my name is Josh Plave. I just kind of want to start it with asking where you think the two largest sources of wealth are for the average American. A lot of us probably know this because we are already retirement investors, but the first one sits in our house and the equity in our homes, and the second one's our retirement accounts. And so, we've all done a great job of recognizing this and taking the steps to use our retirement accounts, though few properly know how to leverage their accounts and how to deal with the consequences that come from that as well. So let's go over how you can invest in multifamily with your retirement account. So the mission I had for Wall Maine kind of came from a conversation that I had with my dad. At the time, this was 3 years ago, he was turning 60. He was planning for retirement, and he knew that, he's a high income earner. And he knew that in a few years, when he ended up retiring, he was going to lose that income and have to rely solely on the retirement account that he had built. And at the time, his 401k is doing great. He's invested in mutual funds, ETFs, and, the markets are at an all-time high. So things are looking good for now, but he's worried kind of about his investments, and by the time he needs them the most, what might happen, and if the market was going to be there for him. So no one really wants to pull from their 401k when the chips are down, and this is really the reality for so many families across America. Just like my dad, you might be afraid that the stock market won't have your back when it comes time to retire. So I chose to build Walta Maine to aim to help investors use use multifamily to de-risk their portfolio and build a better future for themselves. So you might be wondering why a 30-year-old's talking about retirement accounts. I've actually been doing this for about half of my life. I opened up my first Roth IRA when I was 16 years old at the behest of my mother and grandfather, who were both CPAs. They suggested that I start looking out for my future self. I wasn't just focused on myself in that day. And what I did was I took the small amount of money I had earned as a camp counselor that summer. It wasn't a ton, but I opened a Roth IRA. I paid the taxes. I put it into that account. I invested in what I knew at the time, which was aviation. I was obsessed with planes. So I opened a mutual fund that was, aerospace and defense. And it did pretty well. It outpaced the S&P 500 for the next 13, 14 years. And I continued to grow and contribute that account and kind of learn the compounding, the value of compounding dollars. So what ended up happening about 10 years after that was my grandfather passed away. And then a little later, my mother passed away as well. And it wasn't, what ended up happening was I was left with the retirement accounts of a member of the greatest generation and a baby boomer. And so it wasn't really a life-changing amount of money, but it was enough that I needed to know how to be a good steward of their legacy and preserve everything that they had worked so hard for. And so I needed to kind of figure out where I could take those accounts. I needed to kind of go ahead and learn and explore where the prime place was for me to park those accounts and not just invest in the first thing that got put in front of me. So I ended up landing on apartment buildings, otherwise known as multifamily. So let's go over kind of an intro of how we're going to invest in multifamily. I'll take a high level look at it. We'll speak to kind of why it might be right for you in your retirement account. And then I'm going to dive down into some of the details that you should be aware of before you get started investing. So let's first take a look at the type of asset that we invest in, what sort of shape it's in. Most commercial real estate is split into four categories: A, B, and C, A, B, C, and D class properties. And so A class properties are going to be your brand new, high-end, amenity-driven properties that were built in the last 10 years. And D's on the complete other side of that spectrum. It's high crime, high turnover, low-paying tenants in really the worst areas of town, and you really shouldn't get involved in them unless you really know what you're doing. We like to specifically look at B and C class properties. These are going to be kind of your everyday workforce housing that somebody else, somebody always needs to rent. And so the ideal apartment complex is going to be lacking amenities. It's going to, have an opportunity for us to come in and bring in things like, valet trash and some other things. We are able to look for properties that have deferred maintenance. This is a big key here, where, the apartments themselves might be in rough shape because they're not being looked after between tenants. There might be some leaky pipes, and so we can bring in some of our investment dollars, use them as capital expenditures, and really drive up the value of the property. Now, the biggest key that we look for is below market rents. So we're looking for properties that, the current management hasn't been taking a look at their competition nearby, and they're not seeing what they can actually get, the maximum dollar they can get for that unit, compared to something else just down the street. And so that's kind of like the biggest driver that we focus on. And we find across these four metrics, we find that they're typically existing within the Sun Belt. So that's between, Texas over to North Carolina down to Florida. They're not exclusively existing within this area of the country, but predominantly that's where we find them. So as I touched on, the type of opportunities that we look for are value add opportunities where we can really force appreciation by improving the property, with the money that we invest, and by and benefiting from a more properly run apartment complex with a higher valuation. So there's two sides of the coin to how we do this. We look for ways to increase income. We can do things like charge for covered parking, introduce amenities like valet trash. But on the other side, we can benefit just as well from reducing expenses. So something as simple as installing low flow toilets or shower heads, that can have a huge impact, which I'll get back to in a second. But that's really, those two aspects are what drive valuation. So the way that you can actually calculate the value of an apartment complex is you take the net operating income and you divide it by the cap rate, which is essentially just the expected return for a given market when you eliminate the debt that's involved. So lately we've actually been seeing low interest rates. We know that we're in a low interest rate environment, and because of that, it's driven more investment dollars to the multifamily space, which has actually driven cap rates down. So they're pretty low right now, and because they're the divisor in the situation, multifamily valuations are following. They're growing as well. So let's take a look at that equation though. If we're able to increase income by $1 or decrease expenses and build NOI up $1 at a 6% cap rate, that actually is able to drive $16 in value to our investors. And so in a real world example, in that situation when we introduced low flow toilets and shower heads, let's say that drives water bills down $5 per month, and we have 100 units in the property and we build it out over 12 months. Well, at a 6% cap rate, that gives you $100,000 of value just from a $5 change in NOI. So it's really pretty powerful. And the way we get this all done is through a concept called syndication. Now, these properties, tend to cost between $5 and sometimes $50 million. So the way to secure that is through this concept of group investing. It's really when about 20 or more investors come together as a group. They put their dollars together, and it supplies the equity that's needed for a down payment or rehab and reserves. And when you invest in a syndication, there's two roles. There's the general partner, who are known as the GPs, and there's the limited partners known as the LPs. And when you invest with a retirement account, you're always going to be an LP. So as a limited partner, your participation it's purely passive. You supply the upfront capital. The general partners do all the work. They're going to be the ones to operate the property and provide you with the monthly updates and the current progress that's going on site. And that's really what's nice as a passive investor. You get to invest and benefit from your pro rata share of all of the rental income, the high losses that come with commercial investing, as well as benefiting from the proceeds from refinances and sales. So whatever your rate is of ownership, whether you own 5% of the entire property, you get to own 5% of everything that goes on at the property. So when I kind of first heard of this investment structure, it sounded nice, like something I wanted to do myself, but I was wondering if it was a good fit for my retirement account. And so I as I researched everything, I eventually settled on really 7 simple reasons that I think that it is for me at least. And I wanted to share those with you. So the first one is passive income. Your retirement account is required by law, as we know, to exclusively earn passive income. So because it's our only option when investing with our retirement account, it's kind of a perfect fit for multifamily. As a limited partner, you're 100% passive. You're not in control of the investment, but it's actually being done for you, and you benefit from all the passive benefits. So there's no need to worry about compliance when you self-direct. Again, as I mentioned in the first slide, it's not really known to everybody, but you can actually apply leverage within your retirement account. So your retirement account is limited to taking on only non-recourse debt. because, you cannot actually provide collateral and back, a promise for your retirement account. You can only take on non-recourse debt, things that aren't tied to you individually. So the nice thing is for multifamily, we exclusively use non-recourse loans. So the type of leverage we use is actually a really great fit. And the nice thing about that leverage is it actually can supply greater returns when applied properly. So I took a look at things since 1990, and the multifamily industry has averaged, returns of 9% since 1990, and the S&P 500 has been sitting at 7.7%. And also, the deals we typically offer our investors, they return between 15 and 20 when all is said and done after our sale, after we really are able to force appreciation and drive up that value that we talked about earlier. So you'd think that with these greater returns, you'd actually have more volatility, but in reality, it's actually very stable. So I put this little graph together here for you. Since 1990, over the same timeline, multifamily has actually been 58% less volatile than the S&P 500. It's even been more stable than long-term U.S. Treasury bonds. Honestly, this is the single biggest reason that I shifted to multifamily, since I knew that when I needed to access, the funds in my retirement account, there was a much higher likelihood that the market wouldn't be in a sudden downturn at that time. So I'll run through these last three kind of quickly. Multifamily is in a liquid investment. The typical hold time is 5 to 6 years, and that lines up pretty well with retirement investors because, we're typically not touching these accounts for the next 10 to 20 years anyway. So cash flow is a really nice factor. On most deals, investors, tend to expect around 8 to 10% return annually, just from kind of the ongoing rental income that's being collected and then distributed out to investors. And as a added bonus, not only can it help your retirement account grow faster, but if you are over 59 and a half and you can take distributions from your account and you're technically retirement age, you can actually take the income that's coming in as cash flow into your account, and then you can distribute it out to yourself and use that to help support the expenses in your everyday life and really help use that cash flow in your day-to-day. And finally, as Brendan's going to touch on in the end here, there's the potential for totally tax-free growth. So if you are eligible to sponsor a solo 401k, which, as we know, Rocket Dollar could facilitate, you can maintain full tax-free status. So unfortunately, if you can't generate self-employment income, or let's say you got a Roth IRA or an inherited IRA, you have to face the reality of dealing with taxes when you invest in multifamily in a leveraged asset. So let's take a look at what that means. Let's say we buy this building, and the portion up top in light blue, that's going to represent our equity that's supplied by our IRA. And the portion in dark blue on the bottom is non-tax deferred dollars coming in from an outside lender. So the portion in light blue, as we know, was funded by our IRA, and that any income that's derived by that portion of things is completely tax-free. You don't have to worry about that side of things at all. But when it comes to the portion that's brought in from non-tax deferred dollars, and it's coming in from an outside lender, it's considered what's known as unrelated debt financed income, or UDFI. So you need to pay taxes on the portion of dollars that are not in your IRA. Or the income that's earned by those dollars. So that's, it's not the greatest thing to have to deal with this, but the nice thing is, because it's outside dollars, those outside dollars can actually make use of their share of depreciation and operating expenses, interest expenses. So let's say that this deal, 75% leverage here, you need to pay taxes on 75% of the income, but at the same time, you can use 75% of the depreciation and other expenses. So it really helps to offset an appreciable amount of the tax that you end up having to pay, which is known as unrelated business income tax, or UBIT. So just to kind of sum things up, you earn UDFI and then you pay UBIT. Now, the question is, how bad is UBIT? So a lot of people make their career off of saying that UBIT's terrible, and they try to scare people off from investing with their retirement account in a leveraged asset. And I got kind of annoyed at this concept of people really not giving straight answers. So what I aimed to do was I eventually built what I believe is the industry's first UBIT calculator. So this is what it looks like. It's a lot of numbers. It's not pretty, but it gets the job done. And so this is from an investment that we purchased last year in Lubbock, Texas. And the two sections you want to take a look at first are lines 3 and 5. So line 3 on member cash flow, That's what you can expect every single year based off of a $100,000 investment. And line 5 is the taxes that you end up having to pay off of that. And so, having run thousands of deals through the UBIT calculator, I've been able to see that you typically the losses that come from multifamily are able to offset most of UBIT obligations for the first 3 to 4 years. So in this deal, we're seeing $0 in UBIT for the first 4 years. It's sometimes $0. It's sometimes a very small amount. Like here we're seeing about $9,000 in cash flow in year 4. Sometimes it's a couple $100 off of that. So it's not a huge amount, which is nice. The larger tax bill comes, as you can see, in year 5. So we have to pay just shy of $30,000 in tax. So it can be a pretty significant tax. But the nice thing is if you take a look at things in dark gray at the bottom, I've actually broken it down over an annualized rate. And so when you take a look at things over that annualized lifetime of the deal, it actually isn't so bad. What we've found is that UBIT typically will impact your investment by somewhere between 4 and 6% annually. So you can see that before UBIT, we expected a return of about 23% for our investors, and UBIT was able to reduce on the bottom right our returns by 6%. So we're still generating a 17% return, which is pretty nice. I still consider it a worthwhile investment, which is why we went forward with it. But it's something that you do have to look out for. Now, the other benefit here, as you can see, you might see the little yellow indicator at the top there. In year 3, we're actually, we implemented a refinance. And so we're able to return, at the very bottom of this top section there, you can see that we returned $61,000 of our investors' capital. And so the nice thing about that is that's not a capital event. There are no UBIT taxes getting paid on that. So we're actually able to take the $61,000 as an investor and turn that into another investment. So let's take a look at that, because as retirement investors, we're typically not going to be investing only in a 5-year time horizon, not just one deal. We're going to be doing multiple opportunities. So let's take the cash flow from the first 3 years, as well as the return of member capital, in year 3. We'll take all of that. We'll invest into just an identical deal. Just say hypothetically the same deal existed again. And then in year 5, we're going to take the cash flow from years 4 and 5, the proceeds from the sale, as well as the return of the rest of our initial investment. And we're going to invest in a third deal. So by the end of this, it'll be 11 years across 3 deals. And we'll take a look at how things look investing with a self-directed IRA, having to pay the UBIT taxes, and having to not pay it in a solo 401k, and see what the difference is there. So over an 11-year horizon, the growth we see in an IRA, we're able to turn the original $100,000 investment into actually more than $389,000. And that works out to a 26.3% annual return over the past 11 years. So every single year, even though we had to pay UBIT taxes, it actually is able to generate quite a return for us. But if you were able to sponsor a solo 401k, you've been able to turn your original $100,000 into over $526,000, which works out to a 38% return annually for 11 straight years. So if you can invest through a solo 401k, it's really powerful. But if you do have to do so through a self-directed IRA, it's also worthwhile, and it can really be powerful for your overall, retirement plan in the end. So obviously, we all know that life doesn't really exist in a vacuum. Returns are probably going to trail or exceed expectations, not hover right at what we thought they would. But I really just wanted to put this case study together to kind of illustrate the power that multifamily has, that it can bring to your retirement, whether it's through your IRA or through a solo 401k, and just kind of show you what happens when you apply leverage to your retirement account.
Josh, we had a question pop in the chat. So are these real numbers from a previous deal, or is this projections on a possible deal?
Yeah, so this is on a previous deal that we currently own and operate.
That was the Lubbock one, I believe you mentioned.
Yes, exactly.
Okay, thank you.
Yeah. And so I just have a couple, I've got kind of a PDF of 10 tips and tricks that you can use when investing in multifamily with your retirement account. So if you just want to text the number 6686 and text the word top 10 to it, I kind of go over some free, options that you can take to kind of optimize your account and make sure that you're really getting into the best situation possible for what you have in front of you currently. So that's all I got for you today. I would love to answer any other questions that might have come up along the way.
Yeah, we'll do a few questions here if there's any right hot in people's minds. If not, we'll jump into my stuff, but I want to pause for a little bit and any questions here for Josh, and you can turn me back to host, Josh, and then I can enable my video back on. And then Josh, could you type the text number in the chat after you get me to
Definitely.
host here? Yeah, Chris. So Chris he'll get that in a second. And we'll send that out when we send out the recording. We'll post that up on somewhere on Josh's partner stuff on the website. We'll make sure you get that. All right. You can just type that in the prompt. So any other questions about multifamily, more related to UBIT, syndications, how the syndication and deals work? Then I will jump into the solo K. And the purpose for the solo K today is this question this first question kind of popping in is right up the alley of why we're talking about the solo K. Since the solo 401k and self-directed IRA are deferred taxes, why is there a difference between the ROI? And the difference in the ROI, I can just cover that quickly, is because the solo 401k has an exemption from UDFI tax. So UBIT tax is, like Josh has been saying, this is real boogeyman, and we've been struggling that with rocket dollars. A lot of our partners are shy to answer about it. But the solo 401k is exempt from one of the most, aggressive taxes of UBIT. So there's lots of different types of UBIT. UDFI is one of the most common ones in real estate. The solo 401k is totally exempt from UDFI. So you have this amazing tax exemption in a solo 401k that I will get into in a little bit, that can really change your returns and also change how you approach investments. So anything to add to there, Josh? And then we'll
I think you covered it perfectly.
Okay. Chenley was asking, do you guys offer a 1031 exchange at the end of year 5?
Yeah. So the interesting thing with 1031s is they're a little tricky with syndications. So first off, that wouldn't apply to a retirement account. There are no 1031s with retirement accounts. But when you syndicate, with a 1031, because you are deciding to defer your capital gains at the end of the hold period, everyone involved in the syndication actually needs to agree to 1031 their dollars as well. So it can work on smaller syndications if you find an operator who is doing things with 3 to 4 investors who are looking for a smaller property. We typically look for properties that are 100 to 250 units, and so there's a minimum of 20. There's sometimes 50 investors involved, and so it's just hard to get everybody to agree to 1031s together. That said, we do actually offer the potential to move 1031 funds into a syndication. And then at that point, you're able to break off your 1031 dollars going forward because you're not actually part of the syndication. It's a completely different topic. It's called a tenant in common. But if you bring 1031 dollars in, you can continue to kind of roll that 1031 program down the road into a future investment.
Okay, awesome. And Josh, for me to add to that, when you do have those 30, 40, 50 investor, and you have the committee meetings and people are voting, is that get a little toxic sometimes or aggressive, or is it usually just very immutable and it's like, this is it, we're not doing an exchange?
Yeah, they're all kind of the voting powers are all kind of spelled out in the documents that you sign beforehand. And as a passive investor, one of the downsides and something that you need to kind of come to terms with and decide if it's right for you is you end up not having a say. You don't get to kind of vote on things that go on the property. If you want to, if certain decisions are being made that you disagree with, unfortunately, the general partners are the ones who ultimately make those decisions. And so that's really a group of 4 to 7 investors who have experience, and typically it's the main decisions are done by the 1 or 2 people who are focusing on asset management and focusing on the day-to-day operations of the property.
Yeah, so just knowing who your general partners are, and even if you don't, ask them for a referral. Maybe you can talk to a previous investor who's done some work with them before, just to get a personal smell test. If you do, are you going to be able to have a tough conversation with them, or kind of trust their judgment? Maybe if you disagree, if they're making a call you disagree with, that you trust, hey, you guys have done this before, I've seen your experience. maybe I don't agree or understand this, but I understand what type of plunge you're taking. If there's not any more questions, I'm going to get started on the solo 401k. Just bring that up here. All right, and Josh, if you see anything pop up in the chat worth interrupting over, just let me know.
Will do.
And we'll do a little pause. Okay. Oh. All right, Josh, we look all good here?
Yeah, everything looks
Okay,
good.
all right, thank you. All right, so I'll just go through these slides. These are just intros we've obviously already done. Josh's intro. Myself, you might know me from the phone here at Rocket Dollar. If you've ever attended a webinar before, I'm sure you've heard me do this intro. Who am I? Rocket Dollar is a young company, but we really tried to get into the self-directed game to make this cheaper, more tech-enabled, and a lot better service than we felt was out there in the marketplace. So Henry Yoshida had been a CEO here in Austin, Texas. A CEO of a registered investment advisory for many years, acquiring a lot of assets through 401ks. Then he decided to start his own company with a couple partners called Honest Dollar, and that sold with Goldman Sachs a few years ago. So, he kind of got out the financial advisor world, got into fintech, and that was a transition I had been trying to make as well. So after Honest Dollar, he was kind of in the financial tech scene in Austin. He started talking to self-directed investors and just really realized, wow, the fees in this space are ridiculous. Sometimes looking like 2000-ish levels. Tech is not up to 2020 standards at all. Some of these companies don't even have a login experience. And then, you're paying all these fees and you're dealing with this pain, and the service is sometimes, does anyone pick up the phone? So we've really tried to modernize the approach in multiple ways. I came from the University of Wisconsin. I was a financial advisor in Chicago, kind of a similar path that Henry was taking when he was younger. And I said, hey, I want to really jump into this an industry that I think, Henry, you can drive to this. So our founding team has really been pushing for that. I was happy I made that transition to come from Chicago down to Austin here. So I'm going to talk mostly about the solo 401k today, but I will quickly cover our self-directed IRA because sometimes it's tough to qualify for the solo 401k. That'll be the main focus for today, and seeing how we can, even if you don't think you qualify for it, maybe there's some ways you can get into it. But some people are just going to end up using a self-directed IRA, which is our main flagship product. So it can be traditional or Roth. We always use a Colorado LLC, which for passive investments, you don't even have to worry about that. You can enter a passive investment almost anywhere. Sometimes in California, there can be some possibilities. They like to tax everything there. But with almost any passive investment, Colorado LLC is good. We also have a bank account at our partner bank, and this is Solera Bank. They're coincidence, they're in Colorado. People ask, why don't you use a Texas partner? We have Texas partners as well. The reason that we use Solera, they understand these accounts. They understand what it's like to enter a multi-family investment like Josh's, a syndication. They're not even going to question sending a wire to that. Sometimes when there's a lot of real estate activity, business activity, maybe there's a bit of a weird investment that you have in there. Maybe it's a little out there. It's a property that's, distressed or something. All of a sudden the bank starts asking you a lot of questions, and it's not like you're doing anything wrong. It's just that if you're dealing with a self-directed IRA, it's kind of a unique product out there, and it's a bit niche. We're trying to help with the education there, but the average frontline bank employee doesn't always understand what this is. I didn't understand what this was, even though I was a financial advisor in Chicago working in stocks and bonds. So this structure allows the bank account and you as the LLC manager to go enter these investments, that are over here on the right side. And as the investment returns come in, you get to return that to the bank account, all under the jurisdiction of your IRA. So you keep all of the tax benefits there, all the capital gains. You're not going to get appreciation opportunities in here, but the capital gains are going to be shielded. You're not going to be paying tax on any rental or investment returns inside of a traditional or a Roth IRA. And you can enter multiple investments with this, what's called checkbook control, which means you're not just limited if you do one investment. You don't have to start paying us a whole new fee just to do a second or third investment. So the solo 401k, which I really want to talk and get into today, sometimes hard to qualify for, but one of the best, most secret weapons of financial planning is the checkbook control solo 401k. Why is that? One, what you're seeing here, real estate investors, they love this product. They can enter almost any type of real estate. Some competitors of ours, some checkbook competitors will totally ban stuff like single family home properties. And some will heavily push people towards passive. And just myself, just saying out to investors looking out there, passive investing through a checkbook IRA is a whole world easier to do and execute on. It's possible to own single family properties, but there are so many laws around them. We have webinars on single family properties and multifamily. If you're going to jump into a single family home investment in an IRA or solo 401k, you really have to know your stuff. Sometimes it's not the best investment to jump in right away unless you're willing to really dedicate that time, do a ton of education, study the rules and intricacies of that. Whereas a multifamily investment, the second your solo 401k gets in, the second the check comes in from Fidelity, TD Ameritrade, we get that into the solo 401k for you. You're good to go. So what is a solo 401k? It's for a self-employed business owner. We get a plan document to give this business owner a retirement plan. Just like, a small business owner for their 50 employees, just like Verizon and their HR, they go to Fidelity ADP and they create a retirement plan for their employees. What we are doing here is we're creating a much tinier retirement plan just for you. Only you or your spouse. That's the only employees that can possibly be in the company here. And we set it up in such a way that it has checkbook control and it has traditional and Roth accounts inside the solo 401k. So a lot of people don't know. Everyone knows that, a 401k can do, traditional pre-tax dollars. A lot of people just seem to forget it happened in the early 2000s. The IRS said, hey, everyone loves Roth IRAs. People love Roths. People have been asking, why can't I do this in a 401k? So the IRS opened up Roths to 401ks. And when they created the solo 401k, they also opened up the Roth option as well. So you can get that ability if you have enough dollars to invest with a pre-tax account or even a post-tax Roth account, which can be very advantageous as you continue to build up a Roth. So, a $50,000 investment opportunity, you can get a much bigger Roth than some people that might have a, $5, $10, $15,000 Roth. All right. So here, what are some of those common prohibited transactions? Why is it so much easier to do a multifamily investment rather than a single family home investment? Self-dealing. This is one of the biggest problems in self-directed retirement accounts. It's you can't personally work on your property inside of a self-directed retirement account. You can't swing a hammer. You're not supposed to be cleaning it up. You're not supposed to have family staying there. You're not supposed to cross over a personal bank account and a retirement account. And these are kind of these rules that I was talking about. Yes, you can invest in single family home property, but right away, these self-dealing issues, a lot of real estate minded people automatically go, oh my God, how am I going to manage this property differently? What's a great way to do that? Go into a multifamily investment where the management is already taken care of for you. So again, why is this solo 401k just so powerful? You've got traditional and Roth contributions. You can get much higher contribution rates that I'll go into than a self-directed IRA of just $6,000. You can do loans to yourself. So just how you might get a solo 401k loan from Fidelity at work, you can be your own bank and get a loan with no restrictions. You can do whatever that want with that money and you slowly pay yourself back. And then we have the solo 401k is exempt from UDFI. So UBIT, UDFI, again, as Josh says, tends to be this boogeyman of investing. The solo 401k just wipes that off the map completely. Gives you so much peace of mind, less calculation, less trouble, and also higher returns. So how do you qualify for a solo 401k? You have to have some type of self-employed business or sole proprietorship. Something that is generating active self-employment income. This could be a consulting job. This could be some self-employed salary. This could be a little LLC, S Corp, something that you own, a side business, a side hustle, or maybe your main business that you run with just yourself. A lot of people say, hey, well, I get rental income from properties. Can I use that? I love real estate. Why can't I use that? No, rental income is not considered active income by the IRS. Some people say I've got capital gains coming off, blah, blah, blah with my investing. Investment income is also not active income according to the IRS. Some people that manage properties might disagree, but that's how it is. We can't argue with that. So you really have to make sure that you get stuff into box one, which is more like a salary. You can pay yourself a management salary or something like that. You can pay yourself as a consultant for a friend's business. If you're already doing some consulting, you could just ask your friend's business, hey, what about a $2,000 per year salary? The IRS really doesn't have a threshold for how high in self-employment income you can get. If you have $1 in self-employed income, you technically qualify for a solo 401k. That's kind of pushing it. You should probably have something you should get some nice self-employment income rolling through a consistent business year to year, but it can be very small, something like $2,000 or $3,000 a year to qualify for a solo 401k. You're just not going to be able to contribute too much if you have a small salary like that, but you can roll all your old dollars into there. So, a lot of people, they get really frustrated. They're like, well, I don't have a self-employed business. But I really want a solo 401k. We just, I start talking with people on the phone. We start talking through options, and they say, well, is your wife self-employed? Is your husband self-employed? The answer, oh yeah, my wife has her own business. She does real estate, blah, blah, blah. My husband has a side hustle that he does, outside his W-2 job. All of a sudden there's an entity someone wasn't really thinking of. You can only have possibly 2 employees in a solo 401k. You're supposed to have 1, but your spouse can be the second one. You can have no 1099s. You can have, you can have W-2s. Sorry, make sure I get this correct here. So much politics going on right now. You can have 1099 employees. You can have your spouse as a W-2 employee. You can be a W-2 employee. You cannot have any other W-2 employees. No one that's potentially eligible for benefits, because that can get very messy very quickly. So just you and your spouse, or everyone else 1099. And some people ask, hey, can I do, I have a corporate 401k. Does that bar me from a solo 401k? No, it does not. You can do both of them. You can even do both of them in the same year. You just have to make sure you don't go over the contribution limits that are set out by the IRS. So long story short, what is all this conversation, this slide? Don't immediately think that you can never qualify for the solo 401k. Try and brainstorm, try and think through ideas with you and your spouse. See if you can get into it for these great reasons that we're going to go over here. Okay, so traditional and Roth. Most people use traditional IRAs and they use Roth IRAs. A lot of, as I mentioned before, they don't know that they can have both in a solo 401k. This allows you a lot of flexibility. Traditional, you're paying tax back in retirement. So in your 60s and your 70s, when you take money out, you pay ordinary income. Older people tend to, live frugally. Even if they're going on vacations and spending lavishly, they're usually using less money because they paid off their house, et cetera, et cetera. Their expenses are just a bit lower than someone in their 30s and 40s. A Roth account, you put your money in there. As long as you're keeping your investments in there for at least 5 years, you're getting that tax-free status on some of those gains there. So it's a very flexible type of account. People really like it. And you pay your taxes now instead of paying them later on in retirement. So we just had an election. We're all freaking out about it. I'm sure you're all sitting up late watching different news stories about it. Right now, the federal tax rates are about the lowest they've ever been since World War II. That's just kind of a fact of gravity. We don't know where taxes are going to go. Donald Trump had a tax bill and Republicans pushed those taxes lower. Biden's talking whatever taxes for people in rich brackets, and Democrats say this, Republicans say this. We can look at the levels of tax rates and just kind of assume we could see some upward pressure. We could see some options close up. We could see things getting harder to access, maybe different income limits. Who's going to be targeted? It almost doesn't matter. We just have to know, we have to plan for what's in our control. We can plan for the future with that. You can do a mix of traditional and Roth, or if you feel, I really want my taxes to be low and get rid of them now. If your tax bill is not super high right now, you can try and shovel things into Roth. So a lot of people do backdoors and all this complex stuff, trying to freak out how to get $6,000 in a Roth IRA. With a solo 401k, there are no income limits in a solo 401k for the Roth option. Again, no income limits in a solo 401k for the Roth option. If you have a Roth option at work, there are no income limits for that Roth option at work. This has been happening. It's for 20 years. I think early 2000s, forget the exact year, 15, 20 years. People just don't know this is the case. Really want to get that out there. You can do a Roth conversion here. So you're seeing the traditional pre-tax account of the solo 401k. You can convert money just like you would from a traditional to a Roth IRA inside the solo 401k. You keep it in the same orbit. You report it on your taxes. You have to pay those taxes in that year for converting a traditional to a Roth. You have to get that done. But you do not have to move that outside the solo 401k. So there's something called the mega backdoor Roth. I'm not going to go into it because I could talk all day about it, but it's basically the most aggressive Roth converter types of investors that are shoveling just as much as they can to a Roth. And it's the kind of thing that makes someone look like doing a little backdoor Roth IRA. They go, oh my God, I can do all of this through a mega backdoor. I can, get $30,000, dollars more into a Roth IRA. They're all about it. Just very complex to execute. Okay, so again, another advantage of solo 401ks. An IRA contribution is $6,000 a year. I hear on the phone every single day. That's not very much. I wish I could do more. I wish I could put a lot more in there. A solo 401k, if you really maximize it to the absolute level between your personal contributions and also something like a match or employer match, just like you get at work, you can recreate that through your solo 401k. Profit share. A lot of buzzwords I'm saying, basically contributing to your solo 401k just like you would with a rich company match at a W-2 job. You can get almost nine times what an IRA can contribute per year. So this really solves this problem of investors trying to build up and access bigger investments and allows them to save much more aggressively if it works out for their tax situation. If you're over 50, you can get even more catch-up contributions into a solo 401k. So this is getting at $57,000, getting up into the 60s if you're over 50. You can loan to yourself. So totally separate from investing. You can execute on a solo 401k loan, which is very similar to, I work at a W-2 job. I work at, I work at Verizon. And we're buying a house. It's a second house, so you don't get any special exemptions for it. But U.S. Fidelity, they give you a big loan of $50,000 that helps you pay for your house, and then you pay Fidelity back over, to an interest rate over a few years. With a solo 401k, it's your money coming out of your solo 401k. So Rocket Dollar is not the guarantor of this loan. Is your solo 401k that is giving the loan. You get to say where the money goes. You can use it for, if COVID has hit your family hard, if someone lost their job, you can take out money. If you want to buy a Ferrari and get a lease on one, you can take out money from your solo 401k. Maybe not the smartest, but you can do it. The key thing to think here, there's no restriction. So a lot of people ask, how do I shovel money out of my retirement account for a current business or something, close to me that I need to invest to? There's so many rules about investing into your own businesses and investing into close family and friends too. Super close family and friends with retirement accounts. Sometimes it's best to say, hey, I'm not going to invest. I'm just going to take a solo 401k loan because there's no restrictions of these dollars. You don't have to worry about what the IRS thinks about what you do with this money. So what's the typical rule? You can usually take out $50,000 or half of your account balance. So I just have some two quick examples here. In 2019, before the pandemic, if someone had $60,000 in their solo 401k, they could take out $30,000. If someone had $110,000, they can take out $50,000. Doesn't matter how much you have. In normal times, you are typically restricted to $50,000. Now, during the CARES Act, due to COVID, which was passed and changed a lot of different, put a temporary change on some different retirement rules, you can take out $100,000. If you have $99,000, you can take out 99. If you have 100, you can take out 100. If you have 110, you can take out 100. You can pretty much take out all that you want up to $100,000, and then you have 5 years to pay this money back. And then you have to pay yourself at a federally agreeable interest rate, which basically just means something similar to what's out at the best bank out there, but you get to set it similar to the best bank. You don't have to worry about your credit, whatever. You don't have to negotiate with anyone. The government just says, hey, you can't give yourself, you can't borrow from your plan and give yourself a rate of 0. It's a bit, they want to make sure you put your money back in your retirement account. And the great thing is this money doesn't go to Fidelity or Rocket Dollar that you pay interest on. It goes back to you. So you're being your own bank and you're paying yourself back. The IRS forces you to pay yourself back on your own retirement account. This is just a nice incentive to, if you need money, but also you're not cannibalizing your retirement. Because there are what's called CARES Act distributions right now. You can straight up take money out of your retirement account and pay it back somewhere over the next 3 years. But generally what I've seen, I always talk to people, if they take out large loans of their retirement account or large distributions out of their retirement account with no plan to pay them back, they take out huge chunks and they don't go month by month and have a nice plan to pay back. They get a few years down the line and they just don't have the money. It's just a human nature. It's really tough to plan at the last minute for stuff like this. So using a loan and paying yourself back nice and quarterly or monthly, that can plan much better to make sure you don't cannibalize your retirement account. You keep thinking long-term about where's your money. Put it in a real estate investment that's going to benefit you. Think of loans as temporary solutions. Think of taking out of your retirement account as a small one-time or emergency things rather than cannibalizing your retirement account. Because that tax advantage money will really pay off in the end. So we have until the end of 2020 to get these advanced CARES Act loans. Then the CARES Act will go back to that standard $50,000 balance. We could see some extensions or change in that. Just politically, I'm honest, you watch it, I watch it. There's a lot of gridlock. There's a chance these rules could not be extended. We'll see. And the last great advantage of a solo 401k, the UDFI tax. Josh talked about this earlier. It's one of the most common types of UBIT taxes. So there's, I'll speak about these acronyms carefully. There's many unrelated business income taxes, or UBIT. UDFI is a type of income that generates UBIT. So there's many different types of incomes that can generate different types of UBIT taxes. UDFI is the type of income or leverage that is out and generates this. As Josh said, there's ways to write it off. There's ways to get rid of it. But the 998T tax form with the IRS, this is no joke. So as Josh said, don't be scared of this, but this is no easy pushover tax form either. This is something you have to plan for with your investment. You need a CPA that knows how to do this. You need an expert like Josh, to help get you in the right spot to make sure you're working with the right people on this type of tax. You can't take a 990 tax form and just shove it into a CPA that has no knowledge of it. Expect them to just get through the tax form with no issues. What are common causes of UDFI? Someone buys property in an IRA and then they go get a non-recourse loan, which is the type of mortgage you can get. Funds or multifamily investment that have a lot of debt, have a lot of leverage, those can give off UDFI to investors. And if you're passive, and the fund's planning smartly around it, there's chances are you could avoid this tax, but it's something that you really have to talk to your investment provider about. A lot of people ask Rocket Dollar, will this investment have UDFI tax? The answer is, we don't know. You're going to have to go to your investment provider. You're going to have to your investment provider go to a CPA. You might have to talk to someone like Josh, who's an expert that can really lay out what an investment, how it might have UBIT. That's what I like about Josh's pitch, is that all of his investments, he's willing to dive into that topic with his investors and meet it head on. We have a lot, I wouldn't say I blame certain other real estate syndicators for it. We've got a lot of great partners. Some of them just don't have that knowledge and they don't feel comfortable jumping into it to really illustrate that fully for a few retirement investors. Okay. So, with the solo K having this great exemption, I'm going to close things up here real soon. What does that mean for you? What's the big so what of this? So we had a question earlier about this. One, it's an easier lending process. If you're in a multifamily property, you're not probably going to be involved in going to get, the loans. You're not probably going to be involved in the debt structure. But this is just a thing that you have to worry about a lot less with a solo 401k. It's the kind of thing you just let it breeze over your head. You got your friend that went into the investment with a self-directed IRA. you went in there with a solo 401k, they're talking with Josh, they're doing extra meetings with him, they're doing extra projections, they're doing extra work. Maybe they got to get the tax form done. You're sitting there and saying, I did the work to get in a solo 401k. This is my reward. I'm going to sit back and take it and breathe easy. So what does that do? That gives you more investment access. Josh said, you look at these projections, maybe that investment isn't giving you the best confidence on UBIT or UDFI. Maybe that investment, that fund is not planning smartly around it. And then you find out they're going to kick off a ton of UBIT and they have no plan to help you write those off through depreciation. This solo 401k, again, allows you that peace of mind. You don't have to hold back from an investment from UBIT. And as Josh said, you don't want to be terrified of every investment just because of UBIT and UDFI. You need to be aware of it though. And again, higher returns. What does everyone want? They want more money in their retirement account. Being exempt from this UDFI tax can add up over multiple years. And when we talk about retirement accounts, that compounding income is one of the strongest, greatest advantages you have. So even to just have something compounding a little bit each year is getting your nest egg a few more percentage points. The difference between a few percentage points over 10 or 11 years or 7 years of a real estate investment, can have a huge difference on your overall returns for when you exit that investment and look to another one, or when you look at your retirement 20, 30 years down the line. Okay. And someone say, hey, I have an IRA. I see an investment with UBIT. I'm hesitant to enter it now. My friend was making fun of me. He's got the solo 401k and he feels great. He's just laughing it off. And I'm worrying about this so much. Don't be shy and not enter a real estate investment just because it has a UBIT and UDFI. Plan with someone like Josh. See if you can meet a CPA. Talk to the fund administrator. Figure it out. Projection. And kind of put pressure on them and saying, hey, I want to see how this will affect my IRA. So some people ask, well, hey, this investment has aggressive UBIT and UDFI. Why should I invest in it? Sometimes people just want real estate in their IRA. We've had a great stock market year. Some people think that's great. Other people are looking at volatility and their eyes go wide and they're scared. They're retiring soon. They cannot get a 2008 type revenge on their account. So they're saying, hey, I'm going to invest in real estate in a strong area. I'm confident that, this type of real estate can weather some storms. I'm sure that it's sound. I'm more confident in this than, a Facebook stock or a Snapchat stock or whatever is in the S&P 500 that's getting, really crazy valuations. That's all I'll say on some of this stuff. It's been a great year and it's continued to be a great year, but there's many investors that are just eye-popping at the valuation of these stocks and saying, Jerome Powell is doing this. There's a lot of money going on. Everyone's arguing about the valuations, but everyone knows they're pretty high. So again, that investment risk could be just right for your retirement account. Work with an expert to make sure UBIT, is something you're aware of, but you're not scared of. All right. Just closing up here. We've got our 360, 15 bucks a month account for core, which we think is a great entry level for an IRA LLC. This is some of the fee sheet of our competitors on the right here. We've really tried to simplify the fee sheet. A wire fee of 25 bucks if you need it. That's one of the few of only other fees that we have. Past that, it's your 15 bucks a month. It takes care of your IRA, your LLC, and the bank account. If you have a solo 401k, it takes care of your plan document, upkeeping, retirement support, someone to answer the phone, work with you on your solo 401k. And then we also do the Form 5500, which is a tax document needed for the solo K for our gold customers. And I have the Walta main code off here, just a standard 50 bucks off we give for our great partners. And I'm going to close things up here. I know we're approaching our mark. Appreciate everyone sticking with it. Any questions? We'll blaze through them here.
Real quick, while you're going through those, I just want to kind of point out something from the last slide there. When you were talking about the UBIT impact, I would love to share one of those top 10 tricks that I had kind of mentioned that I provide investors. One of them is you can actually get started if you can't sponsor a solo 401k right now. You can actually get started investing with a self-directed IRA. You can invest in a leveraged asset that's going to spin off UBIT at some point in the IRA, and then somewhere down the line before there is UBIT, before the capital gains event occurs, you can actually sponsor the solo 401k and transfer in kind over to that solo 401k. And that'll actually, as long as the asset is sitting in a solo 401k, that'll actually get you to avoid UBIT entirely. Just got to make sure that you're doing this with traditional assets, because with a Roth IRA, it can't go to a solo 401k. But this is a great strategy for avoiding UBIT entirely.
Yeah, and it's something, don't shy away and get started with it. The best is there's investment liquidity, anywhere. Sometimes transferring an in-kind asset, it's a bit harder than a stocks and bonds. So it's something that can be done, possibly. It is sometimes a difficult maneuver, but it's something, don't shy away from it. Get involved with a self-directed IRA. You can reconsider your options. You can enroll traditional IRAs into solo 401ks. I'm going to stop sharing so I can see the chat here. Okay. Someone asked, and I think Josh already answered, but yeah, so can you, I already maxed out a W-2 401k. Can I do solo 401k contributions the same year? You cannot. You can, if you did not max out your employer plan, if you only did like $9,000, you could still contribute to a solo 401k. So there's a $19,000 personal limit, and it's about 38 changes every year about how much company contributions your self-employed income can drop in there as well. You can do an IRA though. You can do an IRA on the side for $6,000. You can do that at Fidelity. You can do that wherever. You can do it with us, and you can dump it into your solo 401k. All right. Any more questions? We're right on the hour here. We'll get closed up and let you get back to your watching CNN, Fox, and Nate Silver on infinite rotation. All right, Josh, I think we'll close it up here. Feel free to send questions to info@Rocket Dollar. I will shoot them over to Josh. I will also, we'll get a recording of this up on YouTube in the very near future. And we've got Josh's number in there. We can text and get some great tips. Thank you. Any closing statements, Josh?
No, just had a good time here, and I appreciate everyone tuning in.
Okay. I'm sorry, we have two last ones from Jerry and Chan. I just noticed them. I'm going to try and answer them real quick. Can a Roth IRA funds be rolled in a Roth 401k? No, it is not. Roths do not require RMDs, Jerry. They do not have RMDs at all, since the government already has their taxes on them. Isn't solo 401k a profit sharing contribution come from the company? Yes, Chen Li. So that you could do personal contributions and you do company contributions. Those contributions become through a match. They can be a match or they can be a profit share. You get the option in the solo 401k. Didn't have time to kind of go through all of those mechanics, but the nice thing is you get two different options. And that's why a lot of people like it more than the SEP IRA. All right, I'm going to close things out here. All right, thank you so much, Josh.
Thank you.